Are we about to get a March Madness melt-up? Markets around the world are up and yields are down, but the Federal Reserve speakers are sending us very mixed signals. Some saying it's too soon, while others claim we're nearly there. So who do we believe in a sea of mysteries? Today, we're going to have a look at the dark pool data, the sentiment data, and 95 years worth of market history following a positive January and February. With gold futures soaring to record highs, we need to talk about what's going on with that metal as well. So let's discuss S&P 500 key levels, why the Magnificent 7 are now the Fantastic 4, and what it could mean for your portfolio, crypto's rise to new highs, and of course, the rotation we all expected. Massive moves happening in so many sectors. Is this the beginning or is this the end? Join us in our special weekend edition of the show. So let's roll the tape. Welcome everybody to a special weekend edition of the show. My name is Chase and you know what we do here. We talk stocks and the financial markets. So if you like this video, guys, please subscribe, hit that notification bell and like this video. It really helps me with the algorithm. Let's get into it. March, the first day of the month, saw quite a rally. Markets up like anywhere from 0.8 to 1.5% across the board, led by semiconductors, technology, software here as well. We saw the big names participate as well. Microsoft, infrastructure software too. They really did put up a good day. But material weakness in here, financials, as well as consumer defensives. We did see strong buy-side support here in healthcare as well, excluding healthcare plans. But energy and real estate also a standout. And I do think that these two sectors are probably going to perform the best here in March. I think gold is telling us that. All in all though, a pretty green day across the board. And I saw a lot of headlines saying a lot of today's rally had to do with the AI trade. I don't think that was the case. I think today's rally was predicated on a couple of things. The first was actually the PMI numbers. They came in weaker. We were expecting 49.5. We actually got 47.8. And this actually sent yields lower. And this is a really good thing because these were getting a little bit out of control. So this actually sent yields across the board lower. And it just means that rate expectations are not going to be moved down further in 2024. So a bit of bad news is good news was on the cards, but it also had to do a lot with the remarks of Fed Waller. He confirmed the plans to slow down balance sheet reduction, said there's no rush. And let's actually go ahead and read some of this article because it was very, very interesting. Now, the headline, the market's excess liquidity is dwindling. The Federal Reserve doesn't appear alarmed. The Fed's overnight reverse repo facility, a place where money market funds and other institutions park excess cash, has moved down sharply to $502 billion from its peak of 2.5 trillion. The concerns have been that money in the overnight RRP reduces. The Fed at some point would need to slow the pace at which it shrinks its balance sheet, also called quantitative tightening, to keep liquidity in the market intact and protect bank reserves. Now, Fed Waller came out and said, I view these funds as excess liquidity that financial market participants do not want. So this tells me that we can continue to reduce our holdings for some time. Waller said the FOMC will start discussing the slowing of the balance sheet runoff at the meeting this month, but the timing of it is a bit unclear. And pretty much what Fed Waller is saying is as long as there's juice in the RRP, the reverse repo facility, we're going to keep tightening. And when excess liquidity gets to zero, we'll start providing excess liquidity to the market. Balance sheet runoff is probably going to start when the reverse repo gets to zero. And a lot of people were looking at the reverse repo facility as a headwind for equities in the future, especially in 2024-25 when it drains to zero. But that's just not the case. You know, the Fed is pretty much implying that when it gets to zero, we will supply the liquidity the market needs. And it was those two things, so the weak data and what the Fed said, those two things led to just a risk on trade, especially in tech, semiconductors, healthcare as well, just growth assets. That was the main trade. And if we actually have a look at sectors, we saw here semiconductors, GDX was up 3.6%, down about 9% for the month, but up today after gold closed at an all-time high. Along with semiconductors, we saw technology, home builders, metals mining, XLE, XLRE, healthcare, software. These were all up 1%, beating the SPY. And the worst performing sectors was regional banks. But like I said yesterday, they were going to get hammered after that NYCB stuff. And then we saw defensive assets, staples, utilities. It was risk on, so they got sold, as well as financials. But I think financials were just taking a bit of a breather. But let's hop on the charts. Now guys, before we dive into the analysis, let's actually have a look at what the markets did on Friday. So the S&P 500 was up 0.8%. The nasdaq 100 as well as mid-caps, the best performers 1.44% and 1.52% respectively, as well as the IWM small caps up a full 1 percentage point. We saw yields move lower as well as volatility. Bonds as a result were bid up, and we saw Bitcoin rally. We saw the dollar decline, gold rally as well as oil rally. So the sentiment definitely was risk on, with a little bit of safe haven buying here in gold. Now looking at the S&P 500 index, this is the monthly time frame. Now guys, this candle right here, that's actually March. We're going to be only looking at the analysis of this candle backwards, so just forget about this one right here. Now looking at candle location and structure, this right here is just a bullish candle. There was no price discovery below. We pretty much rallied from the start of February all the way up to the highs, and we had a little bit of selling pressure here at the top of this candle in February. We actually did have a gap up ever so slightly here at the start of February, but we rallied all the way, and this is very, very bullish because we closed not just in the upper third but in the upper 10th of the entire candle, and again very bullish when you look at that as a whole. If we actually look at the monthly trend, we can see this was the COVID lows. We put in a low, a higher low, a higher low, and then an all-time high here in the S&P 500. At the same time, we did put in highs all along the way in 2021-22, all the way to form this previous all-time high. We then actually did pull back, and then along the way go ahead and make this all-time high. There was a bit of anxiousness right here, but with the fact that we did go ahead and put in an all-time high, there's nothing more bullish than all-time highs. Now on a monthly chart, if we actually do zoom in right here, we can actually afford a pullback all the way to the 41.95 area. Why? Simply because this was the October low, and it's sort of where we began the rally in November. At the same time, we saw right here, here, and here, this line, this 41.95, acted as resistance. We then broke above, resistance became support, and this supported the move we've seen in the last 4 months. If we actually go ahead and measure that move though from the February close all the way down, it's 15.54%. Now that is actually quite substantial. It's in correction territory, but not quite bear market territory. We can actually see quite a lot of downside flows if we do get here, because the market will get very bearish when we do get at this point, because there's a lot of recency bias in the market. What would actually be healthier for markets as a whole is if we do go ahead and pull back to this area right here. The reason why this is a crucial area is because it's just above the December low right here. It's at this point of resistance. It's called the 45.92, let's say 4600 area, and we also used it as resistance multiple times here in early 2022. So if we actually do go ahead and pull back to this area and then go higher, that would be constructively bullish. If we do break below, we can actually see downward momentum all the way to the 41.95 area, and this will be the next level of support we want to look at. All in all though, unless we convincingly break this level, at least on a monthly time frame, it's probably buy all dips, looking for higher price action 51, 52, 5300 in the S&P 500. Now looking at the weekly chart, we actually see something very, very similar. In the last 18 weeks, we've only had 2 red weeks right here and here, and at the same time, all dips were bought as the S&P 500 moved higher. Now this is the most current week. You can see that looking at candle structure and location, sellers, we opened at this point right here. Sellers did take us lower, but then buyers bought the dip and we closed at the high of the day. That's a weekly higher close. In February, a monthly all-time high close, and that's very, very bullish, all things considered. On a weekly chart, you can actually see that we put in a low, higher low right here, higher low again, and a new all-time high. At the same time, making highs all along the way to a new all-time high. Now on a weekly chart, we can actually afford a pullback all the way to the 4800 level right here, 47.95, and we would still be constructively bullish on the weekly chart. The reason why this is such an important level is because it was the previous all-time highs that we made here in late 2021, early 2022. Now, if we do get below this level right here, the 47.94 level in the S&P 500 on the weekly chart, if we do get below it, we can actually see downward price action to the 45.92 level, but we would actually have to look for bear side support at these levels to confirm that. All in all, if we do get here, I do see substantial buy-side support coming into the market, and that's a very attractive place to go ahead and buy, especially considering where we closed for the week at 51.37. Now, in this instance, I'm just outlining to you guys where bulls will come in and support the market. Doesn't mean we don't just keep rallying. We can 100% go ahead and do that. And all in all, on a monthly time frame and on the weekly time frame, this chart looks insanely bullish, and I wouldn't fight the trend. If we are going to pull back, I would look at key levels right here: 47.94, 45.92, 41.95. But really, based on where earnings are and where the market momentum is, I would really honestly just look at the daily chart and go from there. Now, looking at the daily chart, things get a bit more nuanced. The trend is to the upside because we put higher lows all the way in this chart, even right now this week, at the same time putting higher highs all the way up and then a new all-time high. You cannot tell me this isn't bearish. This is 100% bullish. Now on the daily chart, where can we actually look to buy pullbacks? The first area is right here, 49.61. The reason being is because this is a substantial low right there in the S&P 500. If we do break below there, we can probably see flows go to this level, to the 47.94 area, but we can actually look at 49.61 just because it is the open of this candle right here, and this was the Nvidia gap up and go candle. Now, we actually did put in some lows right here, very, very tight lows on the daily chart. You could see that at this point right here, 50.58, buyers did come in a big way and push us all the way to where we are right now, 50.37. Now on a daily chart, if we do pull back to this area, we can look for buy opportunities to go higher. We can also just rally from this point based on how strong this candle was, where the monthly close was, where the weekly close was. Very, very bullish price action. But if we do get below this area, we can actually then look at like 49.61 on a daily basis to go ahead and buy right here. I would say this is a good place to buy, especially with where earnings are and what earnings we are looking at next week. That being said, on a daily chart, this candle right here, Friday's candle, very bullish. We opened and pretty much rallied. We had a tiny bit of price discovery on the lower end, but buyers bought the dip, took us all the way up. And next week, I think what's going to happen is we maybe see a pullback to the 50-58 area, not a big pullback, and then a rally to 51-50, 5200, especially as the gamma flip zone moves higher up the tape. Now, 100%, we can actually just rally from here or pull back to this level right here. That would also be realistic, the 5100 level. In fact, if we don't go lower than the 5100 area, let's say a support like Monday, Tuesday at this 5100 area, that's super bullish, and you can go ahead and buy that looking at higher price action. And if you actually put it all together, guys, if you look at the monthly chart, at the weekly chart, at the daily chart, nothing about these charts is telling you that the market is going to implode, that there's anything technically wrong with the market. We are literally making higher highs, higher lows, and that's the hallmark of just a very strong market. At the same time, the options market is telling us we are in positive gamma, buy dips, sell rips, earnings is coming in better than expected, the consumer is good, the economy is good, and we're going to talk about all of that in the video. So go ahead and subscribe so you don't miss these. Everything we can see in front of us is bullish, and we don't want to fight the trend. We just want to buy strategic locations, and for next week, those locations are 5100, 50, 58 for now. Looking at sentiment, this is very, very weird. BOFA's bull bear indicator ticked down to 6.4 from 6.6. Guys, this was at 6.8 just 2 weeks ago. Then Goldman Sachs sentiment indicator at 1 right now. So we're at the threshold between stretch positioning and non-stretch positioning. And these indicators are telling us that the sentiment right now is still hold assets. So any assets you do have, it is a good time to hold. And if you do want to put some money to work in the market, it's not a bad thing. Just look for undervalued sectors. That being said, both these indicators are telling us to hold and that the sentiment is generally bullish. Now, we got some stats here from BOFA. Let's read it together. So this is January to February barometer. The S&P 500 is much stronger for the year, and March to December when it's up year to date through February. So pretty much when Jan and February are positive, those 2 months, March to December tends to be very, very positive. S&P 500 annual March to December returns for when the index is up year to date through February, also down year to date, and for all years back to 1928. So we could see that we have had a positive January and February. This has happened 55 times. Out of those 55, 44 have been positive. Average return 13.8%, 80% of the time up. When year to date into February is negative, that's happened 41 times and only half the time it has been positive. Average annual returns negative 0.13%. So we have a very strong tailwind right here with the year to date being positive for both January and February. Now adding on to that, we can see here that when January and February is up, that has happened in 35 years, 31 positive returns, average return 15.5%. So guys, being a positive January and February, this could suggest that the S&P 500 in the next 10 months travels to 49.90 to the 5500 level, which is even above my S&P 500 price target of about 53.80. Absolutely crazy stats right here. And this is why fund managers are long equities. This is the NAM number, or the NAM exposure index. And all it is just US fund managers and their exposure to US equities sitting at 88.99. Let's call it 89%. And this is a very high level and an actual tick up from 75% in the week prior. And we know this to be true because US equity mutual funds have actually been decreasing their holdings in cash, not just as a percentage of assets, but also cash in total. And they've been putting that money into equities because equities have been rallying. We've explicitly seen this accelerate here at the start of 2024. And it's probably one of the reasons why we're up 7 to 10% across different indices in the last 2 months. Now, are we in a bubble? That's a question we have to ask ourselves. Now, this is the US equity market bubble gauge. This is an indicator from Ray Dalio. And according to him right here, we're sitting just at about maybe above the 50% mark. This is when we get into bubble territory, and we're nowhere near bubble territory. In fact, we're probably sitting at about the average level going back to 1900, 1910. And you can see here that even when we do get into bubble territory, it could last for like a full decade, like it did here from 1995 to 1999, half a decade. Same thing here in the early 40s, 50s, 60s. But at the same time, we're not in bubble territory at the moment, at least according to this equity market bubble gauge. Now, let's actually talk about earnings, because a bubble is, in my personal opinion, when price does not back up earnings. And what we're seeing right now for calendar year 24-25, bottom up earnings per share estimates are actually moving higher. We've had a great earnings season. Earnings has come in at double digits, and earnings estimates since about the end of January have actually moved up for 2025 as well as 2024. And this is a really, really good thing. This is what you want to see. You want to see price back up by earnings. And if that's the case, stocks actually just generally get cheaper on a price to earnings basis. And the reason why we're seeing this uptick has to do with the Magnificent Seven, the Fantastic Four, the Fab Four, whatever you want to call them now. These are the market leaders in the last 2 to 3 years. And we can actually see, look at Nvidia, look at Amazon, look at Meta, look at their earnings revisions to the upside significantly for this year and next year in both instances. And then we actually look at downward revisions, Tesla. Okay, that's a lot of downward revisions, but for this year, not that much. Same with Microsoft, but they already have like 15% growth priced in for this year. Look at Apple, barely any revisions, and in comparison to the S&P 500 right here. So what does this all mean, guys? That earnings for the names that should be producing earnings, Amazon, Nvidia, Meta, Google as well, guys, that is an increase in already earnings that's expected to grow 14% over the next year and then 15% in 2025. They're increasing earnings, and this is exactly what you want to see in an earnings driven rally. Earnings tick up and companies hitting those earnings. Let's switch gears and actually talk about the consumer. We know corporate America is doing really, really well. What about the consumer? Because 70% of the American economy is based on consumption. Now, this is consumer excess savings. We can see that monthly excess savings since early 2022 has actually decreased significantly, and total excess savings is about at the, call it 750 billion mark. It's taken about 18 months to get here. It's probably going to take another year to get to zero. So yes, excess savings are going down, but this is excess savings. Once this is depleted, they go to personal savings. And this is why the personal savings rate has actually dwindled quite a lot, because people do have excess savings compared to the 2019 average pre-COVID. Not many people are at the average savings rate, and they're sitting at about the 5, maybe 6% savings rate right here. And in January, the savings rate was 3.8%. You just can't see it because it's cut off at the end here. So, you know, consumers aren't really saving, but that's because a lot of them have jobs and are making all the money they need, and they are using their excess savings, but there's still a lot of juice left in the tank. If we actually look at real incomes, this is surprising. This is the real personal income ex current transfers. Real incomes since 2018 have actually increased very close to 10%, and we're sitting at a 4.2% annualized basis over 3 months. And this is the highest real incomes and personal incomes have ever been. At the same time, employee compensation is actually beating inflation both on a 3-month basis, 6-month basis, and 1-year basis. You can see that looking at 1 year, employee compensation increased 5.5%, disposable income is at 4.5%. This is really, really good. And so looking at corporate America, they are looking really strong, holding more cash than ever. Earnings are growing. Looking at the consumer, yes, their savings are not quite there, but that's because they're making a lot of money. And as long as consumers have jobs and are making money, this money will flow into the economy. At the same time, looking at the economy as a whole, one thing we're seeing is US rail traffic up 12.6% versus 2023, 7.7% in total traffic. These are huge numbers, as you can see, and on a year-to-date basis versus 2023 at 7.4% and 1.5%. This is exactly what you want to see, and rail traffic is telling us that this economy is accelerating. At the same time that the economy has continued to be strong, the consumer has continued to be strong. Rate cut expectations have actually come in line with the Fed's forecasts. You can see that this yellow line right here, let's make it yellow, is the median dot plot projection of the Fed, and then we have the Fed fund rate futures right here, and we're sitting at about 4.6%, and investors have readjusted their rate cut forecast. We were expecting 6 rate cuts in 2024. We're now only expecting 3 rate cuts to a federal funds rate of 4.6%, and this is exactly what we want to see in the market. The market has simply reverted to its mean, and as rate cut expectations have been adjusted, the economy has stayed perfectly fine. That's a sign of a strong economy. Rates increasing and the economy accelerating, the consumer staying strong, corporate earnings staying strong. That's the sign of a strong economy. Now, when we do get Fed rate cuts, that's normally an even more bullish sign to be risk on. Normally, Fed cutting cycles are risk on if not followed by a recession, but the S&P 500 has already rallied. Does it matter? Let's look at the data. You can see this orange line right here is the price action of the S&P 500 for the last 18 months. Now, this does assume that we probably get a rate cut like next month in March or in a couple days. I think the Fed meeting is on the 12th of the 3rd. And then this is the average and then recession market returns after rate cuts. And you could see that normally on average, when we do get rate cuts, even though we do rally quite significantly, and like we have right here, we do actually get further price action upward of about 15% returns for the full year. However, if we get a recession in the economy, it's actually not too bad. We normally do rally about 9 months forward, and then we do go on a significant decline for anywhere from 12 to 18 months later. But the question we have to ask ourselves with regards to a recession is, are we going to get a recession in 2024? And the likely answer is no. Normally, the likelihood of a recession in each 6-month period post a yield curve inversion from 13 to 18 months is 61%. The yield curve has been inverted for 502 days. That's about 17 months, and we're slowly approaching this period right here. In the next 30 to 60 days, the likelihood of a recession will go to 61% in the next 13 to 18 months to 14% thereafter. And this right here is actually the average likelihood of a recession. It's actually about 15%. Now, let's actually talk about stocks and the market on a technical basis. So we got the latest additions and deletions of the S&P 500, the S&P 400, and small caps as well. And we can see here that Super Micro SMCI will be added to the S&P 500 on the 18th of March. Same year with Deckers Outdoors. Deleted will be Whirlpool, Zion Bank Corporation. In the S&P 100, Intuit will be added and Excellion will be deleted. In the S&P 400, Whirlpool will be added to mid caps as well as all of these stocks right here, and then Super Micro will be deleted as well as Deckers Outdoors because they're going to the S&P 500. And then notable names in the S&P 600, I don't see any at all. All in all, this is what we can expect, but the big one here is Super Micro and Intuit. And this should actually provide a great tailwind for SMCI, simply because in the months and days leading up into the S&P 500 inclusion, we actually see quite the rally. Now, after the trade date closed, normally the index index does trade pretty flat for the most part. However, do take it with a grain of salt. I have seen various data points on index additions, deletions, and if we actually have a look at the last rebalance, we actually had an addition of Uber into the S&P 500. I do believe it was right about here, and the stock has since in the last 3 months gone on quite the rally. So too has every other stock, and this still has to play out for the rest of the year. It could come all the way down, but that being said, it doesn't mean that we're going to directly trade flat. There could be volatility, but overall in the very long term, I do think it's a good thing to have any company in the S&P 500. Now let's actually have a look at valuations, since we know what's going into the S&P 500 and small and mid caps. Now this is consensus forward PEs. Now the S&P 500 currently trades at 20x. You can see here that mid caps trade at 15x, the S&P 400, and small caps at 14x. And out of all of this, I find mid caps to be the most value, because you pretty much get a valuation very similar to small caps, except you don't get the trash you find in this index. S&P mid caps contain quite a lot of good companies. Like for example, SMCI and Deckers Outdoors were in this index right here. The reason why they go into the S&P 500 is because their performance is just absolutely stellar. But that being said, small caps and mid caps still are relatively cheap compared to historical averages. Now let's talk gamma. Guys, we're seeing the 5200 strike being built out quite significantly. Look at all of this gamma coming into the tape right here. The road to the March OPEX is on. I do think sometime next week, we're probably going to see this call gamma strike move up to the 5200, especially if this keeps growing at the pace it is right now. There is quite a lot of negative gamma in the tape, and the gamma flip zone is at 5,000. But that being said, we're still in positive gamma, so buy dips, sell rips until we get below this 5,000 mark and have sustained price action, maybe even a weekly close below this level right here. Now guys, the NASDAQ composite index just hit an all-time high. It actually did it yesterday, and this is the average path after making all-time highs after a 20% drawdown. Actually quite fantastic, and you can see normally 252 days later the index is up about 20%. We start here at 100, and that's a 20% gain 1 year later. So momentum brings momentum, and this is more tailwinds for stocks as a whole, particularly tech stocks. But this isn't the NASDAQ 100, this is the NASDAQ composite. Now looking at market breadth, now this is percentage of stocks at 10-day highs, 20-day highs, 63-day highs, 126-day highs, and you see all of this green right here, guys. This is like fantastic market breadth as a whole. You can see some of these sectors, industrials, right? Look at financials, look at consumer defensives, look at cyclical services, basic materials. We can even see here in technology. A lot of these stocks are at 3-month highs, 1-year highs, 6-month highs. If we dive into the sectors as a whole, so many of them are at 10-day highs, 20-day highs. We could see a few of them here at 252-day highs. This is exactly what you want to see. Against the new lows chart, virtually no stocks are making new lows. The majority of them are here at 10-day or 20-day lows. And even in consumer defensives, when there is quite a bit of red, you can see here in beverages, electronic gaming and multimedia, lodging as well. It's very specific sectors within it. And the only stocks at 10-day lows that we should be concerned about is potentially healthcare. And that's because they've had a horrid week this week, and they had a fantastic day today on Friday at the very least. We're actually not going to get a correction until we actually get a breath thrust in new lows to the downside. And until we see that and a sustained trend of that, risk is to the upside. It probably means we go higher. It's simply how the market goes. The data needs to change my mind, and I'm just not seeing a change in the data I want to see to be risk off, to get defensive at all. Now let's actually have a look at some of these BOFA charts. Now guys, I do show you guys these each and every single week. These are just technical charts that BOFA draw up for us. Big money look at these technical charts, and they may not use them, they might use them, but it's good for us to look at them to see what the pros are looking at. So the S&P 500 Retail Fund XRT, this is the weekly chart with moving averages. The XRT is coming out of a base from 2022-23 lows, holding the 75 to 73 area would support this bullish pattern with upside potential to 81. You could see here that a measured move from this base, very similar to what small caps IWM looks like. A breakout of this base could take us to 81.95 93 and a measured move target of 94. Let's call it 12 months out, actually 6 to 12 months out. Looking at the S&P 500, a measured move takes us to 5200. We're currently at 5096, guys. So maybe we do see a little bit of a pullback, but we do probably go to that 5200 in the next 6 to 12 months, and a measured move does take us to 5600. And if you go back to the stats I showed you at the start of the video, upside potential is somewhere like 5490 to like 5500. So this might not even be out of the picture with the momentum we're seeing, where 100% can get 5600 by the end of the year, but a lot of that will depend on earnings. Now looking at XLE versus the S&P 500, now energy has been underperforming. If oil breaks higher, that might change in Q2. Now you can see for the most part, energy has completely underperformed the S&P 500 in the last year. However, we did see a big move in oil, and hopefully that does bode well for exceptional energy outperformance. And I'm still very bullish on energy and do think that it's a relatively cheap sector. Now oil versus copper, bonds and gold trending higher. We could see here that there seems to be some risk on here with oil. Oil is trending higher in the interim against copper, against bonds and against gold itself, but I'd love to see what this looks like probably today, because gold notched an all-time high. Now this is Brent oil on a daily chart, and I'm going to read this straight for you guys. Higher highs and higher lows since December's head and shoulders target was reached. It suggests buyers are buying the dip and becoming more confident, while sellers remain steady at near 85. To be a bottom, price needs to ascend through the resistance line at 84.80 to 85, so through this line right here. If oil, it dips first, ideally. If oil dips, it doesn't make a lower low or break the green trend line. If it does, this pattern may not exist and oil falls back to the lower end of $75. So essentially, we want to be risk on above this trend line, pull back, go up all the way, follow this upward channel. But if we do head lower, we don't want to break this green trend line. We kind of want to bounce off it there. If we do break this trend line, both sees risk to the downside. Actually looking at a gold chart right here, guys, look at this exceptional performance from gold, up 1.89%. Just for the record, that isn't an all-time high based on a wick, but on a closing basis, it is an all-time high for gold. And gold is telling us something, guys. Gold is telling us something that we need to be wary of. When people buy gold, what does that usually mean? It's a safe haven. It's risk averse. It probably means that there's going to be easing and more dollars are coming into the system, because essentially gold is just a hedge against the US dollar, or creation of more US dollar. Now looking at Bitcoin, it's looking a bit exhausted. We find some pretty big wicks here, but we actually are closing at the top. Now this is a daily chart. I'm not going to say go fight the trend, but if we do pull back to some of these levels right here, 60,000, and then go higher, that's perfectly reasonable. But we are very close to all-time highs. I think all-time highs is like 66, 67,000. And I think a lot of people are just becoming nervous, especially a lot of Bitcoin speculators, because Bitcoin got to like the 67,000 mark a couple of years ago and then dropped like 70%. So likely, you know, a lot of profit taking happening here. And this is actually really healthy, you know, maybe a pullback and then a move higher. And Bitcoin can pull back all the way to 52,500 and still be relatively safe for a move higher. And guys, the higher price action we get in Bitcoin, this literally screams risk on. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys, like this video and leave a comment. Cheers.